Good day, doctor. My name is Ling and my metric number is 302200. So today I would like to present my study, which is the determinants of the credit risk of the China Construction Bank. Okay, so now I would like to introduce the China banking industry. So China is the most populous country in the world and the second largest economy. Since the economic reforms in 1978, it has transformed an agriculture-based nation into a modern industrial and technological powerhouse. So recent policies like the Belt and Road Initiative and Made in China 2025 aim to boost innovation, green energy and high quality development. So in banking, China has the largest system globally, led by the People Banks of China and major state-owned banks. These banks contribute over 80% of total financing. With rising digitalization, AI and mobile banking, China's financial sector is rapidly modernizing, improving risk management and financial inclusion, especially for SME to support stable economic growth. Okay, next is the company overview. China Construction Bank is also known as CCB. It's one of the big four state-owned commercial banks in China, which founded in 1954. It has grown into one of the largest banks in the world by total assets, while CCB plays a major role in financing infrastructure, housing and national development projects. So in recent years, it has embraced the digital transformation, expanding services in mobile banking, AI and financial technology to improve the efficiency, risk management and customer service for both domestically and internationally. This is the problem statement. The credit risk is unavoidable and directly threatens the stability of bank. So as the 2008 subprime mortgage crisis is a clear example of how poor credit risk management can cause a global financial disruption. So to prevent a similar event, it is crucial to assess the factors that drive credit risk, especially in major banks like China Construction Bank. This study focuses on the understanding those risk factors from 2014 to 2023. Next, we may roughly go through to the three research objectives. First is to identify the internal factors, second is to identify the external factors, and the third one is to identify the both internal and external factors that affects the credit risk of the China Construction Bank. Then is three research questions. First is to find out is there any relationship between the internal factors and the credit risk of the China Construction Bank. The second one is to find out the relationship between the external factors and the credit risk of CCB, and the third one is there any relationship between the both of internal factors and external factor within the credit risk of China Construction Bank. Next is the literature review. For the first is the credit risk, which refers to the possibility that a borrower fails to repay the debt. It is a key concept in banking and calculated using a default probability, exposure and loss rate. While the next one is return on asset, also called as ROA. It helps us to measure how efficiently a bank uses its asset to generate net income, making it a vital indicator of overall performance. The third one is the liquidity risk, which arises when a bank cannot meet short-term obligations due to a lack of accessible funding, especially during the market stress. So the fourth is the loan loss provision, which is also called as LLP, that may refer to reserve set aside for expected loan defaults. It acts as a financial buffer, help banks to remain stable in times of credit shocks. Next is the debt to equity ratio, which compares how much a bank's operations are funded by debt versus equity. So a high ratio may signal greater risk and lower stability. Next is the debt to total asset ratio, which shows the proportion of a bank asset financed by debt. It helps assess financial soundness, which more debt means a higher leverage and risk. Well, next is the capital adequacy ratio that helps to measure a bank's ability to absorb losses. So a higher ratio means that a stronger capital buffers but can also raise financing costs. And the fourth one is the equity multiplier, which indicates the financial leverage. A high multiplier means the bank is using more debt to finance assets, which can increase both risk and potential return. Come through to the last three variables. So for the first is the risk-weighted asset to the total asset ratio. It helps assess how much of a bank's asset carry credit and operational risk. So under a Basel III, this improves transparency and ensures bank manage risk exposure more effectively. Next is the Tier 1 capital to total asset ratio. This helps to measure a bank's ability to absorb losses using core capital like equity and reserve. So a higher ratio means greater resilience, especially during the financial crisis. And the last is the macroeconomic factors like GDP, inflation, interest rate and employment influence overall credit risk. These variables shapes the financial environment banks operate in and impacting lending, liquidity and systemic risk level. So next we come to the methodology. So this study uses data from China Construction Bank's annual reports and macroeconomic indicators from 2014 to 2023. So the credit risk is the dependent variable, while the internal and external factors are used as independent variables. Group them into three models, and so the analysis applied the IBM SPSS version 26 to perform descriptive statistics, correlation, and multiple regression, while the ordinary least square method was used to identify the relationships between variables. So all financial ratios and macroeconomic data were preprocessed in Excel, ensuring clear insight into how this factor influenced the bank's credit risk. Next, we have come to the result. The descriptive statistics table summarized the key internal and external variables examined over a 10-year period, while the average of credit risk is 1.44%, showing a moderate and stable exposure. The return on asset is around 1.13, which reflecting the CCB's efficient use of in-asset to generate the profit, while the liquidity risk average is at 10.49%, which indicates a manageable short-term obligation. However, the loan ratio is high at 64%, that consistent with an aggressive lending strategy. Meanwhile, the debt-to-equity ratio and equity multiplier value is 11.2% and 10.28%, respectively, that suggests a high financial leverage, which means that the bank relies heavily on debt financing. Next is the capital adequacy and Tier 1 capital ratio are both healthy at 16.1% and 7.8% respectively, which assists regulatory threshold and enhancing risk absorption. Externally, the China's GDP growth averaged 5.96%, and while the inflation remained low at 1.75%, the interest and exchange rate also stay within a stable range. Together, these variables provide a solid baseline to evaluate the risk environment and financial behavior of China Construction Bank over the past decades. Next, based on the correlation analysis, the three variables shows a strong relationship with credit risk. Liquidity risk is highly positively correlated at 0.941, which means that when liquidity risk increases, credit risk also rises. On the other hand, loan and market risks are strongly negatively correlated at 0.989 and 0.849, which suggests that as this increase, credit risk tends to go down. So the variable were then grouped by the correlation strength. The medium correlation group includes the variables such as firm size, debt to equity ratio, debt to asset ratio, equity multiplier, regulatory capital, and capital adequacy ratio. This shows a noticeable but not extreme impact on credit risk. Meanwhile, the weak correlation group includes return on asset, interest income to loan ratio, inflation, interest rate, GDP growth, exchange rate, and money supply. These have only a slightly connection to credit risk. This grouping helps highlight which factors most influence credit risk and where deeper analysis should focus. Let's go through the model summary. For the model 1, which includes the internal factors like ROA and loan loss provision, shows an adjusted R-square of 0.240. This means that the internal factors alone explain only 24% of the changes in the credit risk, which is a relative weak relationship. For model 2 with the external factors like inflation, interest rate, and the market risk has improved slightly with an adjusted R-square of 0.252, but they are still quite limited. However, for the model 3 is much stronger by combining both internal and external variable. The adjusted R-square jumps to 0.634. This means has over 63% of the credit risk variation can be explained and shows a strong and significant relationship. So for model 3 gives the most reliable result and proves the credit risk is influenced by the both internal bank conditions and external economic pressure. Is the ANOVA result for each three model. For model 1, which includes the internal factors, shows an F value of 1.569 and a P value of 0.342. This means that the model is not statistically significant. For model 2, which includes the external factors, is also not significant with an F value of 1.434 and a P value of 0.471. However, for the model 3, which combine both internal and external factors, shows a higher F value of 2.950 but still with a non-significant P value of 0.424. Overall, although model 3 has the strongest predictive power based on the adjusted R-square, None of the model reached full statistical significance, likely due to the small sample size of 10 years. Is the regression coefficients across all three models. So in model 1 are all internal factors, which includes the liquidity risk, interest income ratio, loan loss provision, debt ratio, and risk-weighted asset, which has shown non-statistical significance, as all p-values are well above 0.05. This has suggested that none of these variables alone significantly predict the credit risk in China Construction Bank. While in Model 2, which tests macroeconomic factors, also shows no significant relationship. However, the interest rate has the strongest, though still weak, because it is negative coefficient. This result implies that the external factors alone do not drive the credit risk, which possibly due to the CCB's systemic importance and government support. Model 3 combines the both internal and external variables. So here, internal factors has, especially for the loan loss provision, shows a strong negative relationship with the credit risk, which suggests a good risk control. For interest income, slightly increases risk, likely due to the higher risk lending. Still, most results are not statistically significant, but the trend highlights that the internal management factors are more influential than the external ones. So we are now going to the conclusion. In this study, we examined the credit risk of China Construction Bank from 2014 to 2023. Overall, the credit risk remained relatively stable, with a slightly increases in 2015 and 2020, likely due to the market shocks. Correlation analysis shows that the liquidity risk is strongly and positively related to the credit risk, while loan and the market risk shows a negative relationship. However, the regression results reveal that neither internal nor external factors alone could explain the credit risk well, with a low adjusted R-square values. However, when combined, the both internal and external factors in the Model 3 has achieved a much stronger explanatory power at 63.4%, which highlights the importance of the internal drivers, especially for the loan loss provision in reducing the credit risk. As for market limitations, this study only covered 10 years and one bank, which reduced the generalizability. For future research should include the longer time frames, more banks, and additional risk variable. So overall, the strong internal governance, more refined tools, and proactive stress testing are the key to managing the credit risk in volatile market environments.